But that little gap here is this segment. When we go down to the lower time frame daily chart, now you know what you're looking at. Right there. See, it doesn't look like a gap here because look what it's done. It passes back and forth, okay? Do not assume, this is really important, do not assume that a inefficiency, whether it be a fair value gap that's a buy side unbalanced sell side inefficiency or a sell side unbalanced buy side inefficiency, either or, don't assume if it's on the daily chart that if you see on, or a weekly chart rather, don't think that we see these back and forth moves on the daily chart that now makes this a balanced price range. It doesn't, because on the weekly time frame it's inefficient still. The higher time frames have to have bodies hit the floor. That means it's got to cover that gap. Even though these individual daily candles have worked inside that range, that's not, you're seeing the formation of that weekly fair value gap with all of this in here on the daily chart. It's something you have to study on your own, working a higher time frame down to lower time frame. The higher time frames are parent. The lower time frames are subordinate. They're only going to behave in a manner that allows certain price delivery within the context and constructs of a higher time frame imbalance or liquidity pool. That's it. That's the liquidity continuum. What you're looking for. Market has to go up to a premium for what? Only two reasons. It's going up to take the buy stops, or it's going up to some inefficiency, some gap. Markets only go down to go to an inefficiency, a fair value gap below current market price, or it's going down for sell stops. I do not care. This is no disrespect to anybody else out there that teaches and made money. I don't give a flip. The markets don't go up and down because your indicator said so. The market doesn't go up and down because there's momentum of buying and selling pressure. That is not what is going on here. Okay, it's never been that way, but we have been led down the primrose lane with books, authors, teachers, whatever, saying that it's buying and selling pressure. It's not. These markets are absolutely controlled. Period. If we can see the likelihood of price action wanting to at least get up to this level here, why did I use that fair value gap? Remember, I'm painting why I said this was something important. Why did I pick that weekly fair value gap? And why did I want to see it trade through it and become support? Because it's at a level that on a simple run of the daily chart, using this dealing range, this low to that high, remember I'll add the fib back to it. Folks, this is real learning. This is the point. Okay, the point is you want to know what you're doing. If you want to go out there and gamble your money, go watch somebody else. Okay, you're welcome to do that. But if you want to learn, and you want to learn correctly, you're at the right place. That fib at 50 is halfway or equilibrium relative to this high and this low. So if I'm waiting to see price to try to gravitate to here, I want to see, does it perform what I would really rather see happen? I don't want to see it go up there and then sharply break lower, because if it does that, then I got to drop down to a lower time frame and look for a fair value gap or something else on a short-term premium to sell short, because it would likely run into these relative equal lows. But my experience in 30 years told me that all the factors that's going on right now in the world, geopolitically, all the turmoil, all the things that's going on, the economy, all that stuff is a cause for uncertainty. And because of that, I want to see, yes, my PD array is going to be a draw on liquidity. It's going to draw up to that weekly fair value gap. But I already announced to you that I'm going to see this do something other than just go up into it and treat it as an area to sell short from. I want to see it go through it. Does it do so? Yeah. Look where it closed. Above it. I did this stuff real time in live streams where I taught you how to discard or disqualify a fair value gap. So that way, it looks like cherry picking because I'm showing you examples, and a lot of people that hate me or trolls and people can't keep up with me, they'll insist that it's cherry picked, but they don't know the logic. And if they would just simply listen to me now, I'm telling you what I'm doing. So that way you can go back and look at the things I've shared and say, oh, yeah, there it is. There it is. Right. I'm not pulling things out of thin air. I'm pulling it from 30 years of experience. I authored these things. So I'm sharing that language so that way you can learn how to do it. So this fair value gap was the initial draw on liquidity. When we shifted above this high here, that candle right there that runs above that short-term high, that's a shift in market structure. Now market is in a buy program. A buy program is now when you start looking for premium arrays. Where do you look for those premium arrays? Well, what is the dealing range? That is this high to that low. We're only interested in premium. So